Hi, this is Eric Janszen from iTulip. Today, I am pleased to have James Scurlock on iTulip. James is the author of the book and creator of the movie Maxed Out, Hard Times, Easy Credit in the Era of Predatory Lenders. James, welcome to iTulip.
Thank you.
So for the benefit of our listeners who are not familiar with your work, can you summarize your findings?
Well, yeah, I was taking a look at why so many Americans, the majority of Americans, can't save money and can't get out of debt. And what I found was what's really changed in this country over the past generation or so is how the lending industry behaves. In other words, how credit is sold. And, it's responsible for a lot of the news that you see now with the subprime lenders and all these mortgages going bad, but ultimately it's going to lead to much worse than what we're seeing right now.
From your research, do you see a generalized or systemic crisis in the making as a result of the banking industry practices over the past few years?
Oh yeah, very much so. I think we're just starting to see the fallout from some of it, at least on the mortgage side, but there's a lot left. There's the non-subprime market, there's credit cards, there's all kinds of other things. What you've seen isn't just a relaxing of underwriting standards, but what you've seen is a systemic change in how the industry works and how now people behave. A lot of the economists that have been writing over the past month or so talking about whether or not this mortgage crisis is contained, are all arguing, well, if home prices don't go down, if they just keep going up, we'll be okay because people will still be able to cash out the equity in their homes, and that'll keep this economy going, which is really a ludicrous, bizarre concept when you think about having an economy that's based on people losing the equity in their homes. You can go down to zero, but you can't go any further. So at some point, this all has to stop. There was just a report in the New York Times yesterday about the car market and how that's being affected and how governments are being affected by lower property taxes. But I didn't even realize 30%, almost a third of car loans in California are home equity loans. In other words, home equity is being used to buy 30% of the cars in California right now. It shows you how dependent people have become on credit and how the industry has succeeded in selling people on this idea that their house is an ATM.
Years ago, we joked that if Greenspan got on primetime television and gave a 30-minute lecture on sound household finance.
One of the most central dynamic forces is the accelerated pace of financing of homes, cars, and refrigerators, which can be reasonably expected to significantly downsize in the 21st century. More rapidly, creating a perception that coming obsolete at a rate perhaps unprecedented in American history.
About following the age-old rules of not purchasing depreciating assets like flat panel TVs on credit, or
right.
You're taking cash out of your house to do that, that the U.S. economy would come to a grinding halt. If we removed that kind of lending,
right,
how much remains its legitimate use of consumer credit to make purchases?
That's a really good question, and I just don't know the answer, but, the mortgage market, well, a lot of the mortgage market is refinancing. I was talking to a friend of mine in California about a year and a half ago, who's a mortgage broker, and at that time, more than half of the loans they were selling were stated income loans, what the industry calls liar loans, where the bank doesn't verify your income. Something like 90% of those now are people inflating their income in order to get the loan. And almost every single mortgage they were selling was an interest-only loan. So you've got a real crisis in the making when you're talking about those kinds of numbers. How much of it is legitimate credit where people are actually putting down a down payment, building equity, and using credit as as leverage to own assets? I don't know, but I would think it's the minority at this point.
Do you think credit is still a legitimate use of purchases for big-ticket items like cars? We make the argument anything that depreciates really should be purchased with cash. You should save up money and buy it with cash. People, of course, they can't get to work without a car, so they need to purchase something. And cars are not too expensive for almost anyone to purchase them with cash.
Yeah, well, I think the key is to to have an equity buffer. A lot of the problems with these mortgages is that they're 100% down, and these aren't just subprime mortgages or mortgages for little homes. You're talking about $1 million, multi-million-dollar homes. being purchased with no equity at all. That's where it really gets dangerous. If you finance a car for 3 years and you have a significant amount of money down, and in 3 years you're going to still have equity in the car, I think that's fine. But what's happening is people are getting in without having any sort of equity, and the minute the price comes down a little bit, or even if it stays flat, they're underwater, which means they don't have any options. They're really just at the mercy of the lender, at the mercy of the economy.
So do you see a return to the old days of requirements for 20% down, and you will not get a mortgage that's more than, say, 30% of your annual income? Are those days likely to come back? And if so, what do you think that means to the economy?
Yeah, I mean, this is a cyclical thing. In the 20s, the most popular mortgage was an interest-only mortgage, and you've already seen a lot of these no equity or 100% finance mortgages go by the wayside. A lot of lenders are now demanding at least 10%. Whether that gets to 20%, I don't know. But yeah, I think we're definitely swinging back to the old days, because at the end of the day, I mean, Wall Street is getting stuck with a lot of these loans now. I mean, New Century filed bankruptcy. They can't buy back any more loans as they were required to in their covenants. There just isn't going to be the money to fund these risky loans anymore.
Some argue that even houses are not a very good use of credit. They point to Robert Shiller's research that indicates that housing prices historically rise only at the rate of inflation, and interest rate expenses necessarily have to be higher than the rate of inflation, or the banks don't make any money.
Well, yeah, traditionally a home hasn't been an investment. I think this whole idea that you're investing in a home is a new invention. Home was the roof over your head, and you had equity in it. In case you lost your job or something terrible happened, you would still have a roof over your head. It was something that increased in value enough so that at retirement you'd have something to leave your kids. But it wasn't thought of as an investment like a stock or bond. It just wasn't analogous in that way. So I don't think people made that comparison until fairly recently, when there was all this credit. Suddenly you could lever investing in a house. You could buy another house, and I think that's a new phenomenon.
So let's talk about how we got here. Why do credit standards that were required to get a credit card decline so much? In the old days, you had to have very good credit to get a bank credit card. Now you don't. What happened? What changed?
Well, I mean, what happened in the mid-'80s is that interest rates came way, 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 way down, and banks figured out that they didn't have to bring the interest rates on credit cards down at all. So they went from losing money on their credit card portfolios to making a huge amount of money because the spread was so large. Interest rates have stayed low, and interest rates, I mean, the rate at which the bank borrows money, those stayed low, and they were able to keep the rate they charge their customers steady or even raise it. They could really go after any market they wanted to because it was so incredibly profitable. And now we're in this new phase where they're making so much money off the fees and the penalties that it's even more profitable than it was before. So, when that happens, the trick is to just go after as many customers as you possibly can, because even if a lot of them don't pay or end up flaming out, you're making so much money on the ones that you do have and that do manage to make the minimum payment or stay current. You go after the students, you go after high schoolers, you go after senior citizens on fixed incomes, you go after people who declared bankruptcy because it's so profitable.
We've interviewed Dr. Michael Hudson, who contends that monetary and tax policy is intended to create continuous inflation in home prices in order to keep them rising more quickly than the rate of CPI inflation, which determines interest rates. Does your research indicate that sort of intent, or something else behind this change?
Well, my research was much more fly-on-the-wall kind of research, but Paul Krugman, the Princeton economist, will tell you that in an interview with one of the members of the Fed after the tech bust, this Fed governor said, well, all we have to do now is start a mortgage bubble, a housing bubble, and that's exactly what's happened. But I think there has been definitely a policy of keeping this credit flowing, keeping people going another day with credit, and it's succeeded in making the economy look like it's growing and making things look like they're okay, even as people get in more and more debt, even as we have a negative rate of savings, even as bankruptcies skyrocket, even as foreclosures get higher and higher and higher. We can always point to home ownership rates. We can always point to the fact that people can refinance to spend their way out of this thing and keep it going. But again, at some point, that doesn't work.